Welcome back to Market Explained. I'm Maria, and with me, as always, is John. Today, we're exploring a topic that's gaining huge momentum in the investing world: ESG investing.
That's right, Maria. ESG stands for Environmental, Social, and Governance. It's about investing in companies that don't just make money, but also care about sustainability, social responsibility, and strong governance practices.
Exactly. And ESG investing has exploded in popularity over the last few years. According to recent reports, global ESG assets are expected to exceed $50 trillion by 2026. That's nearly a third of all professionally managed assets worldwide.
Wow, that's a massive market. But many people still ask, how does ESG investing actually work? Let's break it down.
Sure. First, the environmental aspect. Investors look at how companies impact the planet. This includes carbon emissions, energy efficiency, waste management, and use of renewable resources. For example, a company that produces solar panels might score high on the environmental criteria.
Then comes the social aspect. This is about how companies treat people. That includes employee rights, diversity and inclusion, community engagement, and customer satisfaction. Companies with strong social practices tend to build better reputations and have loyal customers.
And the last piece is governance, the rules and leadership that guide a company. This includes board diversity, executive pay, transparency, and anti-corruption policies. Investors want to make sure the company is well managed and ethical.
So, when investors look for ESG opportunities, they often use ESG ratings or scores provided by agencies. These ratings summarize how well a company performs on environmental, social, and governance factors.
That's right. And there are different ways to invest in ESG. Some investors screen out companies that don't meet ESG standards, like fossil fuel companies or tobacco manufacturers. Others actively choose leaders in ESG performance, like companies making real environmental innovations or practicing strong governance.
Another approach is impact investing, where the goal is to generate positive social or environmental outcomes alongside financial returns. For example, investing in green bonds or companies producing clean technology.
One question I get a lot is, does ESG investing compromise returns? Actually, research shows that ESG funds often perform as well or even better than traditional funds over the long term. Companies that manage ESG risks effectively tend to have lower operational risks and stronger long-term growth.
And ESG investing isn't just a fad. Governments, regulators, and institutional investors are increasingly requiring companies to report ESG metrics. This transparency is helping investors make more informed decisions.
But of course, there are challenges. ESG scoring isn't standardized, and companies may greenwash, present themselves as more sustainable than they really are. So it's important for investors to dig deeper and understand what the numbers really mean.
Absolutely. And for individuals starting ESG investing, there are plenty of tools and funds available. Many brokers and financial apps now offer ESG-focused ETFs and mutual funds, making it easier for anyone to participate.
Before we wrap up, let's highlight the key takeaway. ESG investing lets you align your money with your values while potentially earning competitive returns. It's about investing in a future that's better for the planet, people, and companies themselves.
Well said, Maria. Whether you're a beginner or an experienced investor, ESG investing is becoming a major part of the financial landscape, and understanding it can help you make smarter choices.
That's it for today's episode of Market Explained. If you enjoyed this discussion, make sure to subscribe and leave a review. Next week, we'll explore another trending finance topic that's shaping markets worldwide.
Thanks for listening, everyone. See you next time.